Hello everyone, hope you're doing well. Welcome back to the Road to Retiring channel. As you can see on your screen right now, we have a comment recently from Jodye asking us to analyze a series of stocks, and we're going to get into the first one of these today, which is Alibaba. If you do enjoy this content where I value stocks and give my predictions of what the future values could be, please do drop the video a like, subscribe, and leave in the comments down below any other stocks you're interested in hearing my thoughts on. So, Alibaba, what is it? Well, it's a retail company in China, and we're going to do a little bit more information on the company as a whole after we've done our valuation, if the valuation is at a point worth buying, because if the valuation's not good, then we'll wait to see when we get those valuations and then have a little further look into the company to see if it's something we want to invest in. But first of all, let's have a look at the value of it. So, in terms of the income statement, the profit margins have fallen quite drastically from 17, 18 and 19, sitting really healthy above 20%. You can see this dropped down to just above 20% in 2020 and all the way to 7% in 2021. So that is slightly worrying. And if we look quarterly, it's a bit all over the place. They actually reported negative earnings in 2 of the last 4 quarters, in 2021 quarter 4 and in quarter 2 of 2022. So minus 9% profit margin in quarter 2, minus 8% profit margin in quarter 4 of 2021, and most recently they had an 18.9% profit margin. Now if they're able to keep the profit margins around this level, which they reported in quarter 3 of 2022, then that definitely could be a good sign to see in the future. But right now it's very, very sporadic, and I think we need to add a little bit of margin of safety because of this, because it seems really, really inconsistent. Now, when we look at the ratings, they're really good. The technicals are buy and the analyst ratings have a massive upside of 49.69% with a strong buy recommendation. But we're going to have a look at the value for ourselves and see if this is something we agree with. So in terms of managing risk, the other things we like to look at are historic growth rates in a few metrics. The first of these being earnings. We want to see historic growth, and as you can see, they have this. We want to see levels over 10% a year, and for Alibaba, this is way above that. From 2014, it was reporting $2.25 earnings per share, all the way up to $8.31 earnings per share in 2021. So as you can see, this is climbing really rapidly, and that's really, really great earnings in terms of growth. But there is an issue with this. Now, this is the non-GAAP reporting. If we look at how EPS has been growing in terms of the GAAP reporting, you can see it's very different. Trading 12 months is only $1.73 per share, and if we look annually, in 2021 it was only $3.58 on the basic earnings per share when they're looking at how it's reported on a GAAP basis. That $3.58 compared to the non-GAAP of $8.31 is a very, very different picture. And so because of this, if you have a look at their current valuations, you can see the price of earnings non-GAAP is currently 11.46 for them, whereas their price of earnings GAAP over trading 12 months is 48.29. Now, this drastic difference is kind of scary, and we want to see them close down a little bit and become similar again, because right now I do not like those levels that I'm seeing in terms of the earnings reports on a GAAP basis. Okay, on top of this, we want to see revenue growth for a company, and it's actually really, really impressive for Alibaba. You can see 2014, 12 billion, compared to 2021, 134 billion, timesing by over 10 times, 11 times, maybe it's even over 12 times, I think, from 2014 to 2021. Just crazy, crazy growth, and it's forecasted to grow quite nicely into the future as well, up to 170 billion in 2025. So the revenue growth's really strong. So in terms of non-GAAP reported earnings, that's really good. The revenue's really strong in terms of growth. And the other two we like to look at are cash from operating activities, which is pretty good. However, there was a drop off in 2021, which is not too great. You can see this was growing really nicely up to 2020, with 35 billion reported compared to 8 or 9 billion reported in 2015. But this value in 2020 fell by around 12 billion in 2021, down to 22 billion. So not a massive fan of seeing that fall, and we're going to hope to start to see that growth again in the years to come. And lastly, we want to see equity growth, and they actually have fantastic equity growth. From 2015 at 38 billion compared to 2021 at 170 billion. This is way over that 10% a year level we like to look for. So there is good and bad amongst the historic growth rates, and it's mostly good. It's just the price of or the earnings reported on a GAAP basis are very different to the earnings reported on a non-GAAP, and the cash flow has started to drop, though overall it is still very impressive growth. So majoritively good. We might add a slight margin of safety to it, and the reason I want to add a margin of safety more is because the management decisions being made are not showing effective investment to me. If we look at the return on invested capital, historically this was nicely above that 10% benchmark we like to look for, but over the last year or so you can see this has fallen a lot, down to levels at 6%, 4%, 3%, down to 0.6% in quarter 2 of 2022, and it has picked up again slightly in quarter 3 at 2.6%, but really we'd like to see this above 10% to know the management are making effective decisions. So because of this, we are going to increase the margin of safety slightly. Now lastly, the thing we want to look at to manage risk is the financial position of the company. If we look at the overview, you can see the financial health's actually quite strong. Their cash in 2021 was about 8 billion larger than their debt, so they can pay off all their debt with their cash, and their free cash flow is also about half the size of their debt, which means they could pay off that debt within 2 years of their free cash flow. And typically I want to see a company be able to pay off debt within 3 years, so that is really strong in terms of the debt, free cash flow, and the financial health. So that's actually really good to see. And also on top of this, you can see that their assets are sitting very comfortably over their liabilities, with nearly 40 billion more short-term assets and over 100 billion more long-term assets and liabilities. So really great financial health and financial position. So because of this, we're only really going to be adding the margin of safety for that return on invested capital, and for the cash flow and EPS being a bit different based on GAAP and non-GAAP reporting. So we've gone with a 15% margin of safety, a little bit higher than the typical 10%. Now if we look at the analyst 5-year estimate, this is 3.24%, but this is accounting from not the current year. If we look at the annual growth, this is basing it off of it being 8.31, which was reported in 2021. Now, we have put our prediction in from 2022, so that's why we've gone for a slightly higher growth rate expected than they have, because the growth rate from 7.76 is going to be higher than the growth rate from 8.31. So going off a 6% earnings growth with the 9.5% discount rate, and we've gone for a minus 0.7% share dilution as they have been starting to buy back shares. With a price of earnings multiple, we've gone for 13. You can see typically the sector median for non-GAAP is around 11.19, and Barbara's has typically been way higher than this at 28. So I do think there's a premium with Alibaba. However, a premium that high at 28, I do not feel comfortable. And also, if we look historically, when their EPS growth was around 12%, this then had double that in terms of the 5-year average at 28. So I think having a price over earnings multiple around double what the earnings growth expected is at 6%, I think that feels more comfortable. I've gone with 13 for that slight premium and an earnings multiple around double the amount of the earnings growth rate, and that will bring us a fair value in 2028 based on price over earnings of, that is completely not what I wanted to do, is reset that. I wanted to change the text, of $75.69, which is a 2028 price of $140, and we'd still be looking for around a 20% drop in price, personally, based on the price of earnings if we were to get into this. Now, there's still a great return on investment there, and it's actually 2027 price, not 2028. Now, that, as I say, is still a great return on investment to $140 from the current levels at 95 in 2027. That would still be great because of that margin of safety, and because it's a little bit of a larger risk investing in an individual stock. We want to make sure we're getting it at a really great price, and based on the price of our earnings, that great price is around $75.69. For price over sales, this was slightly easier because they don't have differences in reporting based on non-GAAP and GAAP accounting. So if we look at price over sales, they're going from 126,920,000 in 2022, which is what we have here, up to 170 billion in 2025. So we put that into our estimates with a 10.3% earnings growth rate, and we've gone for a price to sales multiple of 2. Now their price to sales multiple has typically been really high and has dropped down a lot over the last couple years. Currently trading at around 1.79, was 1.82, 1.65 in recent quarters, but I do think this will steady out around levels at 2. That's a level I feel comfortable at, and based on that, that would bring us a fair value, because of the price over sales calculation, of $88.88, which is much closer to the current levels and would only require a 6.79% drop for us to become interested. Now lastly, the price over operating cash flow multiple and fair value calculation, we've gone for 2023 value, what it currently sits at 23,750. We've gone for a 7% growth rate, taking the operational cash flow just slightly above what the net income will be in 2027 because of things like depreciation. And if you see, they have a really high amount of non-cash items. If we have a look at the funds from operations annually, you can see their non-cash items made up 10 billion of their 22 billion in cash from operating activities in 2021. So we will expect this to sit quite a bit above what their net income is expected to be, and I reckon that will be around the 33 billion mark in 2027, bringing us a fair value based on the operating cash flow of $85.73 and a 2028 price of $158.78. So taking the average of all of these, there is a good return on investment here, which would be around 10.14% per year on your investment if it was to hit these average prices of around $154.53. But because of the margin of safety we've set due to the differences in non-GAAP and GAAP accounting, and because the profit margins are a bit jumpy at the moment and the return on invested capital not being high, because of all of these factors, we've set that slightly higher margin of safety, which means we'd be looking for around another 12.5% drop before we fully go in depth into the company details and look to see if it's one that we want to invest in. Now, please let me know if Baba is one that you like, and if there are any other stocks you'd like me to have a look at. If you enjoyed the video, please do drop it a like, subscribe, and I'll catch you in the next one. Bye guys.